Gentlemen, how are you? It's the crypto sniper, the market sniper, saying hello. And yep, let's have a little look at crude. In fact, even better, I'm going to take you into the wonderful world of dollar. So everything relates to everything. Many people look at markets in isolation. One of the things you learn on a program is 360 degrees analysis. So in one of our courses in the program, one of the key chapters is having a look around at all markets that have a potential relevance to a particular trade that you may be considering. Maybe it was fine where it was. So this is the dollar index. This is the dollar index. So let's talk about the dollar index for a bit. This is where we've been before. Let's go really far out. I can put back here again. So yes, dollar index, long sell-off period following the dot-com bust that saw the dollar index at one point at 120. That's right, 120. All the way down, 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 down. So if we're tops and tailing this current market, which is something you'll learn about on our super macro analysis elements, you would probably say 120 is the logical round number that you spend very little time above. And you'd probably argue that 72, 74, maybe the round number of 75 is begging you to take it, is roughly the level around which you spend very little time below. That gives you the opportunity to middle point. And if I was to middle point that, you got 75 to 120, you add them together, you get 195. Essentially, the temptation to make this 100 is just too big. So key round number, it's going to be a very, very important mid-level, that 100 level. So if you're at 120, I would be tempted to go 70 or even 80 just to get a midpoint there. So I'm going to go for I'm going to squeeze this a little bit higher, this top bit, and take it up a little bit, so that you have an 80 and a 120 number. There's been a little bit more time below the 80 than there's been above our 120. So I have engineered this slightly, but the 100 level is such a key, significant level of significance. Okay, so after the sell down, you're at extreme lows down here for the dollar. We got this structure some while ago. This is now 2010, all running into the post-crisis period where we went exceedingly low vol. You'll also learn about the gift of volatility and how a squeeze then begets further. If you pop into that, you'll drop a time frame. You'll see that there was in fact a squeeze, all occurring in and around that 80 dollar index mark, which was for a very sustained period really low, and that was. Well, it was kind of dollar index at its lowest. We went into 208, and then we had a major surge in the dollar index. Remember, the dollar index had a lot of euro in that. Then we started to have the various euro crises, and then the dollar reasserted coming back up here. So a little bit of the history, but the 100 is a key level, and I've kind of topped and tailed it, skewed it a little bit, but that should just give you the context that you need. So the argument we're going to be making is that there is a real problem. The dollar has had its spell of strength that we forecast about 3 to 6 months ago. That has played out, and now it's actually doing the opposite. We had that blow off high for the dollar index, and we traded low. We called round here that it would probably rally, and it did. You'll note lots of structure like head and shoulders here that turned and sold off, rally up to the target key level of significance, another head and shoulder, rally off. That's all on the weekly. Let's put it on the daily so you can see that all a little bit more clearly. We'll compress some of the data. There you go. So then a little bit of a non-standard head and shoulder, just a spike down there, big head, fairly chunky right shoulder, and then it bounced one more time. Each time it was kind of supporting, just running through the key 99.5 level. This was all bouncing around where the 100 is. You can see what the key level was, the 100, even though you're sitting there, probably 99.5 was it. Target was made to the downside, little fractal of heads and shoulders, target made, eventually up, another fractal of a head and shoulders down, target made, eventually down here, squeeze. And this was the beginning of our period when we said the dollar is going to have a recovery run. And it did have a recovery run. And then in this upside HVF, which was a downside HVF on the Euro USD, we said again another point where dollar will get stronger. And it made it there. However, where we were less accurate is what happened after that. After that, it made target and it turned into a reversal. This is kind of a push up and then as hard back down. So this is like in a single candle, this is like a shooting star. You know, big tall wick opens here, trades all the way up, trades all the way back down and closes. So that's an exhaustive event. So that then created also a reversal structure. This all being a left shoulder with two necklines. We've got our upside HVF's neckline in the axis there, and we've got where I would probably have picked the neckline using HVF method. You'll learn about this on a course. You can pre-reg. A couple of things you can do while I'm on this, guys. Pre-reg for our mini course that we'll be releasing. We're only going to have 100 seats. It's entirely free. Pre-reg, the link is in this video on it. It's had to be compressed, so it's a bittle, but go reg for that. For all these people that leave YouTube message, can't afford your course, quick mini series, you will get it. We'll start rolling that out from the second half of November, and the first 100 people get it. Thereafter, it's closed. So anyway, so with that being said, we also have a free webinar, by the way, coming up for October the 3rd. Interesting take on both cryptos and many other things. But so left shoulder head, right shoulder, neckline. This was a distinctive break after hammering on it for a sustained period. So once again, let's drop the time frame. So you've seen the context of this. We're going to drop the time frames and bring it in. Now you get a return move after a key level break. It's quite typical, but the suspicion here is that there's more scope for downside on the dollar now, having made that target that we called for. No follow through though. We'd said possible it will follow through. It reversed. So where does this leave us? Well, this brings us to what I actually want to discuss with you. And I still think there's possibility this can rally back to the line again. It's not going to give you plain, just single one-way direction plummet. None of these things have ever done that. You had a nice sell-off there and a moderate rally on that fractal head and shoulders, and that triggered quite well. And after making target, you can see how it bounced back on that little fractal. This was a bit of a non-standard one, took a while to get going. You would have thought you were away, then you had this rally. Many would have closed the trade instead of standing by their stop. Again, churn, but then eventually it went and it went and it went all the way to target. So actually not bad compliance for head and shoulders. Slightly non-standard one, but you know, upside HVF and a left shoulder in our advanced course that we will be marketing. So another key announcement to make. We are doing a self-study program that'll come in at a lower price point, but it'll do introducing HVF, intermediate HVF, right the way through to advanced HVF that you can self-study. And we are working on developing that out as well. And people that get the free micro course will be the first to be kept up to date with that development. But all that aside, the head and shoulders have done well. And one of the things you'll learn in the advanced course is how HVFs dovetail with traditional technical analysis patterns and how you can exploit them. In other words, the left HVF in the left shoulder. Anyway, down, possible rally, but we've had reasonable compliance on head and shoulders, and this is quite convex. It was very, very strong, started to lose a bit of momentum, then had a blow-off event, had a bit of a grind sell. It wasn't capitulative. There was a bit of a pushback, but that can come. So maybe a bit of a rally back up. Who knows? Maybe up to even there. But I would suspect that at some point there's a reasonable chance that this target gets made. So there will be opportunities for the short trade. But this now brings us, this is all about one half of a trade. And this is an example of the 360-degree analysis we do in our Sniper Circle over here. This is our premium platform that our full trading metamorphosis guys get. Everything I see and observe is posted in here, and then into the individual setups. So we do all the detailed setups. All the guys are doing setups, and we're looking and working trades all the time. On our WTI, let's show it to you on how we set it up in here. If we'll go FX and commodities, and WTI is of course Western Texas Intermediate. So there's Brent, which is kind of like the most commonly used oil. and you will find it, everywhere. We want it in setups, please. It's the Western Texas is a heavier oil and takes more refining, so that's why it sells for less than clean Brent. So you can subscribe, for example. I've taken the trade, so you subscribe and take the trade. You get a WhatsApp chat box that goes with it. So this was kind of the macro. And I did push this chart through Twitter, but this was an interesting one. In fact, I've got an even better one in here, which I updated with annotations in the chat. So this shows you a little bit about what we're saying. So just in a key level of significance and individual candles, this is a monthly chart for oil. We are known for calling the ascending inverted HVF one of the first. I don't know anyone else who said oil is a bear when it broke through the $103 mark. Up top here, where you see that red cross, yes, an ascending inverted HVF, which was going to give overperformance to the downside to an already low target that was in the 60s, the upper 60s. And what did you get? You got a downside move to 25 that took out the 2008 collapse lows of a major depression. I never thought that would happen. This goes to show you trade what you believe, not what you see. And later we find out the facts. There was a major glut. The shale licenses were given. It was all designed to put pressure on Russia, Venezuela, and Iran. It's political. It's financial warfare. It's all everything. But anyway, here were the big hammers. Hammer there, hammer there. Wicks show illustration of buying. But if you look just at the hammers, we've always had a good buy after that. Another hammer at the low there, good buying period. Another repeat hammer there, another sustained buying period. Another hammer there, bit of a big body there, but it was a look one way, go the other way. Hammer, you got a hammer here, a huge one, but it was getting near the end. You still pumped, hammer, pump, hammer, and you went. But you were battling to make new highs, and eventually you actually had a small hammer there that failed. It didn't mean higher highs. That was one that failed. Like, you got a little bit, I would say, wicks here, but you definitely got a hammer there, a single hammer. That failed because we went new lows. Then you got a two hammer structure, and that was it. That was your low bottom. Twice you rejected on monthly candles. So typically I don't trade tactically on hammers alone, but this is an incredibly large time frame. So these are really significant captures of data. This is not a 5-minute fractal. So those two arrows are showing you two successive hammers. We pumped, that was your low. You got another hammer there, you went higher. Again, you tested there. Two hammers in a row there, you went higher. Kind of a hammer there, a little bit of a big body. And now we've just had two amazing hammers, small bodies, but this one's trading higher. So the body is expanding in a row, which is pointing to higher oil prices here. Plus, remember, it's in the dollar, which I've just done the dollar index. So you've got a unique period where we're talking about Trump going after Iran, increasing sanctions. So this is now a fundamental discussion. Move it away from the charts. Pressure on Iran, saber rattling, military industrial complex getting geared up. Lockheed Martin made upside HVF recently. You've got trade wars causing issues. You've got the Europeans looking for an alternative to the SWIFT system, as they don't want to be dragged into the Iran issue. So that all undermines the dollar. You've got the BRICS supposedly undermining the dollar, etc. You've got a number of things. You've got an unpopular president with some and very popular with others, but essentially being very divisive. The trade war narrative with China is going to leave questions asked. Hey, these guys, America wants more jobs and wants more manufacturing back in its own country. How do they do that? They need an advantage. They're not more productive. They don't work longer hours. They need a cheaper currency. Okay, so that's going to help. So there's a bit of a currency war theme going on there in terms of keeping things up. It's also a great way of keeping the stock market up. You devalue the dollar. It means the stock market doesn't have to fall as far for a revaluation. All that said, that's all very fundamental and nice. It doesn't lead to the trade. This was the macro view that we have for the oil to go higher, and I'm looking in and around to revisit previous legacy inverted HVF funnels. You'll learn all about it. We've got all those draws on our sniper circle here, these levels there. So that is your big macro time frame right now. Now, if I take it back to the trend, you never quite got your perfect inverted head and shoulders. You got a left shoulder there, but not really a convincing shouldering event here. And there's a lower line you can draw across here where you get essentially a left shoulder to this level, roughly here, and then you messed about for a very, very long time, and then you eventually kind of the target 75, and we're all but there. So it's not in there, but I am highlighting. I still left the arrows for where all those successful on the bigger time frame hammer events were. So this is your pattern view. This is when we've been watching it for a while. We traded long. You get your break, you get your revisit, second chance. You'll learn about the 5 stages. That'll be in the intermediate module of your self-study program once that's released. The 5 stages of a breakout. You get a break, and then you get what's called the second chance. You see a bit choppy there. Revisit the funnel. That's why the train sometimes comes back into the station for you. If you come back and you speculate and you buy at the funnel level, you get chipped back in on a sketchy candle, and then next thing you're up. So the expectation is, the second interim will be run. There's a bit of selling, and then we'll have a little bit of a rest, which brings us up to probably where oil is today. So I'll take you to a live chart and away from the board. And you can see we just ran those interims there, and then you get the falling wedge dip back, which then eventually gives you a little bit of a pop. Not significant follow through, so it could fall back a little bit more. So it's not the time to chase in, and you're not about to miss out. And in fact, you're getting a little bit on a dollar index. You're getting a little bit of a bid up at the moment. That's also a small hammer. It's on a very big time frame, not very big for crypto. It would be very big. Daily is a reasonable time frame, a little bit of a hammer. So a little bit of revisit time here. So that might take a little bit of sale out of the winds of the oil chart, which we're in here. You could dip further back. So that does mean you might get offered a lower level to get in. Where's the target? Up to 74.6. You're going to have that big number, 75, leaning on you. So for me, $50 oil, $75 oil, and $100 oil is a very significant troika, and we're at that midpoint of the 75. You can embellish that further and say $125 oil all the way down to $25 oil, and then you have a 75 midpoint as well, because we've had both 75 and 125. So that's really tops and tailing it, as we like to do on the super macro, but 75 keeps coming through. So we had a primer set up that wound up in there. You can see it. It was also detailed in here. We did a trigger time frame. We showed you, and you can drop down. You could have optimized this with a very good entry over here, right down just through the 70, and stops could be just at the 69. So potential for good trade, but this is one a little bit set and forget. It's big time frame, and it's going to have its journeys of ups and downs in working forward. But the overview is that you're probably going to get somewhere up to a 90s, in the 90s. I put a target of 91. On that primer, you got your funnel so squeezed. I didn't get that entry, by the way. I'm not claiming that, but that actually gives you 100 risk reward. How many people are putting out trades where the potential was there? Even if you get it just down to 10, you've done really, really well, and you're only long at 72, 73. It's not the end of the world, but we focus on RRR, risk reward, and we want it done in a reasonable time frame. That's why we trade breakouts. I was stunned to see on some guy's Twitter feed, who's very highly followed, 6 digits on technical analysis, saying, his head and shoulders is his favorite patterns, and symmetrical triangles are very unreliable. In actual fact, the HVF structure is the best time to trade. It allows for tight stops and highly expansive moves. So yeah, definitely want to watch. What does this mean? It means also for things like the TRY, this could actually be a downside break. That same analyst that's been watched by so many people on Twitter is calling for this to be another melt up move. He may be accurate, but if while the dollar is rallying, you're getting this rising wedge structure and a little bit of a rollover, and then you're going to have this bumping up against this grind line. We'll teach you about grind lines in the intermediate module. So the course planning is going ahead. You often get a break and then a revisit, but there's a strong possibility that it won't be an upside break. This is a very narrow, very impulsive blow-off. This could be what we call slap in the face event. You'll learn about that in the advanced module, which we'll be teaching in the self-study program, which, as I've mentioned, will come in cheaper than a trading metamorphosis program. No community, none of that, but you can just go and learn how to be an HVF trader and self-study. So big sell-off on the interest rates, probably the end of that impulse, quite flat, very low slung. Be careful about assuming that the people that are pushing this as a long-only trade. I'm staying undecided and even mild bear. And that means going long lira against the dollar. I mean, you can't say we don't take brave positions, especially what's going on. But there is a point where something starts to represent overvaluation in the dollar in terms of what's going on, and undervaluation potentially in what's happened in the time frame that it has happened for the lira. So a couple of things I've taken you a walk past by. Precious metals not looking that interesting or great. They are getting they've ceased their sell-off thanks mainly to the dollar's weakness, but they're not the commodity with all the zip in the can. It's not where the power is. Oil looks more attractive. By the way, as I do this lira, if you were to get a performance down to target on an inverted setup, let me just leave it with you that it would in fact take you to the key levels of target of the previous upsides that you were trading over there. So key levels of significance, that would be right down at the fives. Many people go, never happen. Big sell-offs in the dollar versus emergings do happen. And it's not only a one-way ticket. Otherwise, everyone's net short the rand, the lira, and the real all day long, every day long against the dollar, and we'd all be millionaires just shorting emergings. Actually, the dollar has issues too. Plenty of them, and in some cases on a bigger scale. But they swing the focus on the FX. That's the control structure for you. Okay, so that's a little bit of a take on all of that. So webinar, October the 3rd. Come and find out about not only defense, but how you can make money, and a true trader makes money being able to short, and actually markets fall faster and harder than they go up. What our take is on when the cycle will turn for crypto. Learn how and the value of defense and items such as the recovery ladder in our webinar, and that is October the 3rd. Register and seize one of those free slots for the micro course on key attributes, and we're going to just give you a taster in the micro course of what we're about, and you'll get it delivered for free. There will be 100 seats available, and that will start rolling out, as I said, second half of November. And we will close that once 100 seats are registered. That's in the link on this YouTube. Go to the website to register for the webinar. That'll be October the 3rd. And keep an eye out on that dollar. Suspicion is she's not going to be so strong. Euro US dollar is a final close. It shouldn't have popped out through that red level. That tells you it's invalidated that performing inverted funnel that we called and traded, and that won. So that trade was a great winner with a decent risk reward. We got in early on a much tighter funnel than this relatively fat one. But the residual that was held over did not go for the inverted targets and invalidated. So that residual was closed with less profits than originally envisaged after the impulsive nature of the return move for the euro. So that's the markets for you. HVF patterns, higher validity, higher level of probability of performance than head and shoulders patterns, and that performed, but you didn't get your roll-on super performance to the downside. So that's an update for the dollar that took in oil, lira, the dollar index, and the euro USD. Hope you're feeling well served by that, and go and register. Otherwise, just continue to share and watch the YouTubes until such time as you feel motivated and serious to take it. Trading's not for everyone. This is not advice. This is just my take, and I can be wrong as much as anybody else. Thanks for watching. Bye for now.